Hello, Ottawans. I'm Obaid, your real estate agent, and we're joined by a very special guest today, Fred Knowles. Fred is a mortgage broker with the Mortgage Source here in Ottawa. He specializes in educating home buyers on all of their available mortgage options, helping you save most of the money through the life of your mortgage. Fred, how are you today?
I'm doing excellent, Obaid. Thanks for having me in, and I'm looking forward to this.
Thank you for being here. All right, let's dig right into it. There's a big argument between variable mortgages and fixed mortgages. What's the difference between each of them, and how should a home buyer pick one?
It's a good question. So, with a fixed rate mortgage, it tends to be a little bit more of a popular choice because with a fixed rate, your rate is guaranteed for the full term of your mortgage. You hear about all this Bank of Canada rate talk. It doesn't really apply if you have a fixed rate. If you have a variable rate mortgage or you're looking to get one, that's when you're going to be looking more at the Bank of Canada rate talk because that will directly affect the rate that you have with a variable rate mortgage.
Does it make a difference being a certain type of a buyer to choose a specific type of a mortgage?
It absolutely does, actually, and that's something that I actually like to cover on my initial outreach with a potential buyer, is just seeing what their plans are, especially for the short term, if they're looking to access equity in the near future, or maybe looking to lock into a rate in a year or so down the road.
Yeah.
Maybe a variable rate would be good. If they're a little bit more risk adverse, they don't like all the fluctuations, a fixed rate's a perfect plan for them as well.
Wow.
Yeah.
One of the main questions we ask our buyers in our initial meetings is, have you been pre-approved for a mortgage? And even though the answer might be yes, it gets really slippery once we get to the closing of the transaction. So how important is it to get pre-approved for a mortgage before house hunting?
It's funny you bring up that situation where people claim they're pre-approved and something happens along the approval process when they have an accepted offer. So the answer to that is it's very important to take a little bit of time and make sure you're properly pre-approved in the mortgage for a mortgage. The biggest time when we saw that was during COVID, and banks, for some reason, were advertising these quick and easy 60-second pre-approvals.
Yeah.
It didn't do anyone any favors. Your life is going to be so much easier if you get a proper pre-approval. Take some time, make sure everything's checked off before you make an offer on a house.
All right. What are the steps involved in getting pre-approved for a mortgage?
The most important step is that initial outreach with the buyer. What type of employment do they have? Are they self-employed? Are they salaried? What's their credit profile looking like? What's their down payment situation looking like? How are they going to come up with their down payment? If we tackle those areas up front before the house search, make sure there's absolutely nothing that can come up along the way. It just makes that process more enjoyable from when they get pre-approved until they had their keys in hand.
What are the top common misconceptions and mistakes to avoid when it comes to getting pre-approved for a mortgage?
Yeah, one of the common things I see with that is people tend to go online, find an easy pre-approval calculator or a mortgage affordability calculator, and then they start going out to open houses or looking around for houses to buy when they're not really pre-approved properly. So going back to getting a proper pre-approval, that's the biggest thing that I can recommend, is making sure that you have everything in line.
Yeah.
And then that way, when you're out looking for a house, it makes it a more enjoyable experience knowing exactly where you're standing and what you can afford.
Down payments are a big financial upfront. It also plays a role in getting the deal done for some transactions. What are the available percentages of down payments?
The minimum down payment you can put on a house is 5%.
Yeah.
So if you have the 5%, that's a good start. From there, what we look at is the 5% all you have? Are you able to put a little bit more? And the reason why is because you have to remember that with a down payment of less than 20%, you now have to pay a mortgage insurance premium.
Yeah.
So on a 5% down payment, you're paying a 4% insurance premium on the mortgage amount.
Okay.
On a $400,000 mortgage, your mortgage is now $416,000. You're actually creeping a little bit closer to 100% financing. So it's a good way to get you in the door, but if there's ways that you can get a little bit more than the 5%, it's always recommended.
You see the best rates are available for high ratio insured purchases. Is it worth it to pay the premium to obtain that low rate?
Almost always,
Yeah.
it's not worth it
Okay.
if you can get to that 20% down. So the 20% down payment is that key number where you can avoid the mortgage insurance premium. But you're also right where the best rates on the market, those best advertised rates,
Yeah.
are for those high ratio purchase mortgages. I know it's a little bit weird how that works.
Yeah.
Now, if you only have that 5, maybe 10% down, it doesn't really matter. You're paying the insurance premium anyway. But if you can get close to that 20%, if you are close and you feel 15% down or 20% down, I would always recommend the 20% down. Lower monthly payments, lower mortgage amount, and at the end of the day, you're saving a ton on interest as well.
When we talk about being realistic when it comes to affordability and how much you can realistically afford, what would be a good advice in that subject?
In that case, what I love to do is just take a look at the scenario that someone is in right now. Maybe, for example, they're renting. We take a look at what their rent is. And then we take a look at maybe a house that they'd like to buy, what the mortgage payments would be monthly on that, adding in the additional expenses, property taxes, insurance, everything that goes into that, and see where you're going to be at the end of the day. And not only that, it's the change in lifestyle too. So I get approached by people who are renting, but the biggest issue is maybe they're an hour and a half commute into their office and they can buy a house closer to where they work. That gives them a big advantage in their lifestyle as well. Bring that all into play and then see how they feel from there.
Mortgage rates during COVID were as low as below 1%. Now they stand at 4% and dropping continuously. Variable rates get affected by external factors. How are they determined?
Variable rates are determined by the Bank of Canada setting their overnight rate. So when we see these usually about 8 times a year, the Bank of Canada comes out with a rate announcement. If they increase the Bank of Canada overnight rate, banks will react by increasing their prime rate. If they decrease the overnight rate, banks will react by decreasing their prime rate. And that's how your variable rate will be affected during that period. So when we are going through that inflationary period, those existing variable rate holders were affected quite a bit during that time.
Fixed rates, on the other hand, follow a different trend. How are fixed rates determined in regards to the mortgage rates?
If you are a fixed rate mortgage holder, these Bank of Canada announcements, again, don't really apply as much to you. What you're focusing on is the bond yields.
Okay.
So if you have if you're looking at a 5-year fixed rate mortgage, the 5-year bond yield is what's going to mirror each other in terms of where that's trending. So I like to use a website called marketwatch.com, and that shows where the bond yields are trending. And you can look yourself, like when you're looking at the trends, if it's going upwards, banks are likely going to react by increasing their rates. And if it's trending downwards, which it is right now, banks will very likely react by lowering the rates due to that.
On a personal level, what's the impact of an interest rate on a monthly payment?
So I think the best way I can answer that is by giving an example. So if you take a rate, let's say 5%, and you compare it to a rate of 4.75%. That difference is going to be about $14 a month on a $100,000 mortgage. So per $100,000. So if you're looking at a $500,000 mortgage, something a little bit more realistic, you're looking at about $70 a month difference on that 0.25% difference in rate.
So at 25 basis points on a 500,000 mortgage would affect you monthly, would increase your payment monthly or decrease it by $70.
Yeah.
A lot of home buyers focus mainly on the lowest rates that they can get. Is it always a win to secure the lowest rate on the market?
Technically, with a lower rate, your monthly payment is going to be lower. That is true. The issue that we run into is the only thing you really see advertised from banks is rate, and nothing else about the mortgage that you're going to be getting with that rate. So the one thing that I always live by and that I set up most of my buyers with is we are going to get you a really, really great rate but with a mortgage that has really flexible terms and conditions. And what I mean by that is low penalties if you ever want to change or break your mortgage for any reason, including obtaining a lower rate down the road, and something like prepayment privileges. Are you able to just, if you have $1,000 lying around that you want to put toward your mortgage, are you able to do that? With some banks, you can just log into a portal, click a couple of buttons, away we go. And that's how you really see and realize the long-term savings of your mortgage. Great rates, but with a really good bank.
Credit scores, they play a factor when it comes to mortgages. What contribute to setting that score on an individual level?
When it comes to credit scores, I think people focus a little bit too much on their actual score itself. What you should really be focusing on is what's reporting on your credit bureau, are there car payments, etc., and your credit history as well. Have you been making those credit card payments consistently? What are your balances sitting at? It's a very important detail, but it goes beyond just the score as well.
What are the best practices to help increase credit scores?
In my opinion, the best possible way to increase your credit score is to make sure that if you have, let's say, a credit card, and there's a little bit of a higher balance reporting on it, even if you're making all of your payments on time, if there's a high balance getting toward the limit, if you lower it even to below, they like to see below 30% of the available limit, then that can increase your credit score as early as the very next time it reports to the bureau.
So this is to increase it. What are the top practices to avoid that will definitely lead to decrease your credit score?
Well, the biggest thing is you don't want to miss any payments. And the reason why you don't want to miss any payments is because that reflects on your credit report, that shows on your credit report for quite a long period of time. And so things happen in life. We see all the time, great people, great applicants, something happens, they missed a payment or two here and there. And that's actually where we come into play. And we can just give a story to the lender that says, hey, this is reporting on the bureau. Everything else is very strong with this applicant, great borrower. And we can help out, make sure that we can still figure out a way to get an approval, even if there's something showing on the credit report.
Mortgage refinancing, it can be a great tool for accessing equity. Most people think about refinancing their mortgage when the rate drops. Is it actually a good idea to refinance your mortgage just because you're getting a lower rate?
Only if the math makes sense for that. And what I mean by that is when you renegotiate your mortgage, you're breaking your mortgage. So when you break your mortgage, it comes with a prepayment penalty. If you have a variable rate mortgage, it's going to be, again, that guaranteed 3-month penalty, 3-month interest penalty. If you have a fixed rate mortgage, it can really vary depending on the bank. So if it's not expensive to break your mortgage to get that, to obtain that new rate, absolutely could be an option. Otherwise, we just have to make sure if it makes sense depending on the factors.
Aside from penalties, what other factors should homeowners consider when deciding whether to refinance their mortgage?
A lot of times what comes into play with the refinance is, do they want to access equity for a debt consolidation? Do they want to access their equity for a home renovation? It's usually something that comes up for a reason why they want to access the equity that they built into their house. And then again, we look at the factors and costs that come into play for doing that and see if it's a viable option.
And what are the top benefits of accessing equity through refinancing?
The biggest benefit is that you're borrowing money to do these renovations, to go on a trip, whatever the reason is, at a very low interest rate. If you look at alternative options outside of refinancing, you might be looking at using a credit card, which is very high interest, as we know. You might be looking at using an unsecured line of credit, which could be very high interest. So it's a great way to tackle expenses or anything that you want to do at a very reasonable rate.
All right, let's talk renewals. It's a hot topic these days. When it's time to renew your mortgage, is it best to stick with the same lender?
I have a client who's up for renewal. I like to make sure that I reach out to them about 3 months before they're up for renewal, because The biggest thing that can come into play when deciding to stay with your current lender or not is your current situation. Have things changed? And then I'll work with them with their current lender to try to get the lowest possible rate we can get, so you don't have to go through the requalifying process with a new bank and go through all that work. Let's see if we can work to see if your current lender can be fair and get you a good rate up at renewal. It's the easiest route.
And what are the crucial factors to consider before renewing your mortgage?
Taking the time to see, hey, do I have to access equity from my house? Because this is a good time to do that if I need to, because you would be able to do that penalty free. From there, again, a very important point would be, what's changed in my life since I got my last mortgage? Has my income changed, my employment type changed? So we go through that, make sure we look at all the options, but just making sure you know where you stand at the time of renewal, very important.
Are there any costs involved during renewals when switching from one lender to the other?
So the short answer to that is there's very little to no cost involved.
All right.
And the caveat to that is you have to make sure that it will be a direct transfer from one bank to another without adding anything to your mortgage or making any big changes to your mortgage. But if you're just going from one lender to another, maybe just for a lower rate at maturity, most of the time the new lender will cover the cost of setting up any legals. There's rarely an appraisal needed. It's a pretty straightforward process.
Canada's real estate market could be quite challenging, especially for newcomers, whether you're looking to rent or buy a house. What are the key factors to look into if you're a newcomer to Canada thinking of getting qualified for a mortgage?
The biggest thing is just to make sure that you have some established employment. You're starting to build your credit history. Now, we can talk about your credit score and profile, where it's not mandatory to have that fully established, but you want to have it started.
How can a newcomer build his credit history?
The number one piece of advice I have for a newcomer who's trying to build their credit is get a prepaid credit card that will report to the credit bureau. Some of them don't report. You just give the bank $2,000 and they give you a $2,000 credit card, but it doesn't really do much for you if it's not reporting. Same with a cell phone. Anything like that that's small that can report to Equifax is a really great way to get things started on building a credit history.
How does Canada's stress test affect newcomers looking to getting a mortgage?
The stress test applies for everyone buying a house, whether you're buying your 10th house or you just arrived in Canada and you're looking to buy your first house. You are going to take whatever rate is being offered. Let's say you're being offered a rate of 4.5%. We have to show the bank that you can qualify at 2% higher than the rate you're being offered. If we can show that you can qualify at that higher rate, then you're approved. They'll go back and give you that lower rate. It gives the bank also that little extra comfort of knowing that if something happens where you run into a difficult time, we made it a little bit tougher for you to qualify, but you might still survive some tough times.
Is there anything else a newcomer should consider before buying a home in Canada?
The biggest thing for that is just to make sure that they are aware of what products are available out there from different banks. There's a lot of different banks who have different types of programs for newcomers. Some of them are more forgiving on maybe a very new credit profile. Some are more forgiving on the down payment side. So it's really just having a discussion of where your full profile is sitting so we can set you up with the proper bank.
Buying your first home is a big milestone. It is very beneficial to know what governmental programs and incentives are available for you. What government programs or incentives are available for a first-time home buyer?
We used to have the first-time home buyer incentive, and that turned out to apply to almost nobody. It was not a very well laid out plan, and I think that's well known, and it's actually been discontinued. But there's a couple of programs that first-time buyers can still take advantage of. One of them is the home buyer plan, where you can use funds from your RRSPs up to $60,000 per applicant, tax-free, toward the down payment of your home. That's a pretty popular program now. And the other one is with your land transfer tax, you get a rebate instantly of $4,000 at closing. So if your land transfer tax might be typically $5,000 on your purchase, you get $4,000 of that exempt. You're only on the hook for $1,000.
Okay.
Yeah.
I mean, it's good for a first-time home buyer. It's better than buying your second home, right? What are the most common pitfalls first-time home buyers should avoid when applying for a mortgage?
You want to avoid those quick and easy pre-approvals. You want to make sure you are very well prepared to go out and make an offer on a house. Another big thing is just making sure that your expenses are in check. You're not making any large purchases. Maybe if you're thinking of buying a new car, you wait until you have keys in hand for your new house before you go make those large purchases, because it really does affect your affordability.
Yeah. Getting approved for a mortgage is tough enough. But being self-employed and running your own show, it adds a layer of complexity. What are the challenges self-employed individuals face when applying for a mortgage?
Hands down, the biggest challenge a self-employed individual faces to qualify for a mortgage is the paperwork they have to submit to the bank and what the bank uses as their income versus what their actual income is. And what I mean by that is, if you make $150,000 a year, you write your business down to, let's say, $60,000 a year, the bank is going to say you make $60,000 a year, and they need a 2-year history. They're going to use a 2-year average of your last 2 tax filings with your net income to come up with what they say you earn.
How can self-employed individuals prove their income to the lender?
There's the traditional way that we were just talking about, where you can submit your tax documents and good luck with everything. If it works, it works on that 2-year history. However, what a lot of people don't know about is there's really cool alternative products out there for self-employed individuals. And I'm not talking about private lending or anything like that. These are actual scheduled banks who have products that cater to self-employed individuals, where they would ask for 6 to 12 months of bank statements, see how much you're bringing in based on your bank statements, and then based on the industry that you're in, they would just deduct a reasonable amount of expenses based on the industry. No tax documents at all. You're usually looking at about maybe 0.5% to 1% higher rate, but it can get you so much more affordability for that house that you want to get into.
If you're self-employed, what should you do to improve your chances of getting approved for a mortgage?
The thing that I like to do in these cases is look at the full profile. So a lot of the times I do ask for those 2 years of tax documents, send them over to me and let me take a look, because if you can get approved for a mortgage using that net income, then it opens up a lot more avenues for you, and you actually get that better rate and controls the costs. But if it doesn't look promising in terms of affordability side, then we have that discussion of using other means and methods to get an approval at a price point, at an affordability range that is realistic for you.
Are there any additional costs that self-employed individuals should be aware of when applying for a mortgage?
The main thing to focus on in that regard is if you are using something like a bank statement method, where you show the bank your 6 to 12 months bank statements as opposed to the tax documents. With those products, it usually comes with about a 1% lender fee on the mortgage amount. So on a $400,000 mortgage, you'll have to come up with $4,000. If we're going to talk about a little bit of a higher rate as well, which can be an additional cost compared to the lowest rates on the market, your rate would be a little bit higher using that method as well. So there are some extra costs, but you have a huge benefit of not having to change anything in terms of how you file your taxes. So.
All right. Let's talk about something that doesn't get a lot of airtime: private mortgages. Most people think about going through the big banks when it comes to mortgages, but there's a whole world of private lenders that could be a game changer when it comes to mortgages. So what exactly is a private mortgage, and how does it differ from a traditional bank mortgage?
Well, the biggest difference in this regard is that private lenders are not regulated like the banks are. So they're able to come up with solutions and take on files that are a little bit more risky because they can kind of set their own rules to an extent.
Who typically uses private mortgages, and why might they choose a private mortgage in regards to a traditional bank mortgage?
People who need to use a private mortgage are usually people who are in maybe a unique financial situation. They might have a large cash component with their job. There might have been something that happened on the credit side of things where they just need a little bit of time to build back their credit history and come up with a plan to get in a better position on that end. An exit strategy with a private mortgage is very, very important. And what I mean by exit strategy is, okay, so you're in this position now, but what's your plan to get out of this position in the future so we can pay out this private mortgage, get you with an institutional lender so you're not stuck with higher fees and interest down the road.
What are the advantages of going to a private lender versus a traditional bank lender?
A private lender can help get a deal done, get you into that home that you love or that you're looking for.
Okay.
And they're a little bit more flexible in that regard than a bank is.
Okay.
So when a bank says no, but it's you find a house that you love, or even if you're in a situation where you have an accepted offer on a house, for some reason the bank turns around and says no, we can set you up with a private lending option, which will at least get you into the house, and then we figure out a way to pay out the private mortgage from there back into getting into a bank. And again, that comes down to having a strong exit strategy to pay it out.
What are the drawbacks of a private lender? Why should someone avoid it if they could?
The biggest thing for me is if you find a private lender, maybe not through a mortgage broker, but just you Google someone or you deal with someone who may not be working in your best interest, that can be trouble down the road for you. We don't know what they'll offer you at a renewal. We don't know, there could be a lot of hidden fees and charges. So for me, that could be a drawback. Very important to make sure that if you have to go the private lending route, it's with a very established mortgage investment company or an established and vetted private lender who we know is acting in your best interest.
Let's tackle a topic that can be both emotionally and financially complex, dealing with a mortgage during divorce and separation. How does it affect a mortgage for a shared property?
In all reality, if there's a situation where a couple are separating or getting a divorce, they're very likely not going to be living in the same house anymore. That's just the reality. And from there are options available from banks. They're pretty lenient to help out with that. But we have to make sure that we go through the lawyers. We go to the lender on their policy and see what the best outcome we can come up with them for is.
What are the common options available for spouses going through divorce when it comes to the property?
Two common options. Number one, simple, look at selling the house. If there's a situation where for some reason don't want to sell, maybe it's very much down market, one of the applicants, one of the spouses still wants to live in the house, banks have a pretty good program actually, where it's called the spousal buyout, where it can be treated as a purchase and one of the spouses can purchase the house from the other and actually do it up to 95% loan to value.
A topic that's often misunderstood but can be a powerful financial tool is second mortgages. What's the difference between a second mortgage and a primary mortgage?
A primary mortgage, a first mortgage, is usually an institutional lender that already has a mortgage in place. And they hold first position. If the house ever, let's say, goes into foreclosure and they need to take over the house, the first mortgage holder will get paid out first. A second mortgage would be registered on title against your house, but in second position behind that first mortgage.
What are the common uses for a second mortgage?
The most common reason for a second mortgage is there's something has come up where someone doesn't want to touch their first mortgage. They want to keep it in place. Maybe they have a very great rate. Maybe there's a very high penalty for breaking that first mortgage. So as a short-term plan, they can get a second mortgage that can help them do debt consolidation, home repairs, what have you. And then when the first mortgage is up for maturity, that's when we can strategize to pay out that second mortgage, refinance everything back into a new first mortgage.
And how do interest rates on a second mortgage compare to a primary mortgage?
Interest rates on a second mortgage are much higher than a first mortgage. There's no sugarcoating that. We're looking at 10 to 12% range interest rate on average, which is why, again, just like a private mortgage, you want to make sure there's an exit strategy with this second mortgage. So again, a very popular way of dealing with a second mortgage is setting one up and taking care of what you have to take care of in the short run. And then again, once your first mortgage is coming up for renewal, a great opportunity, penalty-free, to wrap everything, the first and second mortgage, into a new first mortgage, get it paid out, and go from there.
Fred, this is the end of our episode. Thank you very much for being here. We appreciate the time. And do you have any advice for a first-time home buyer?
I'm going to go back, especially for the first-time home buyer. I'm actually very impressed, especially that Gen Z generation and younger millennials who you have that assumption that they don't want to talk on the phone. They just want to do everything digitally over email and all that. That's not really the case. And this younger generation, they're very, very well researched and they want to know what their options are. And so if you're a first-time buyer, you can do that research on your own, but make sure you have a conversation, a full conversation with what your plan is, what your goals are. Get yourself a proper pre-approval and go out and really enjoy the home buying experience when you're looking for a house.
Thank you very much.
Thanks a lot for having me, Obaid. I really enjoyed it. Thank you.
Thank you very much.
This is amazing. This is a crazy experience.